Hi again. We are going to continue on the topic of financial analysis. As we have seen in the previous video, we have gone through the item on balance sheet. For today's video, we will look at the projected balance sheet. A projected balance sheet is different from a past balance sheet or known as a balance sheet. Okay, in the sense that a projected balance sheet communicates expected changes in the future. So the element there is future asset investments, outstanding liabilities, and equity financing. Whereas the past balance sheet communicates the organization's actual and historical financial positions. A projected balance sheet provides the most relevant financial information needed in the business planning process. So you use this projected balance sheet to make planning in terms of the short-term planning or a long-term planning for the company. There are 5 elements for a projected balance sheet. The first one is assumptions on assets, liabilities, and equity. And we also have project assets items, project liability items, project equity items, as well as project discretionary financing. In terms of the assumptions on assets, liabilities, and equity, the organization will need to make certain assumptions. So again, because it is in the future, you make assumptions on how individual balance sheet items may change over time in the future. These include the asset. So we have the assets, we have the liability, as well as the and the equity. So this item will change. How does this item will change in the near future? And then we have the business plans, often focus on anticipated future sales. The projected balance sheet also starts with forecasting sales revenue. So you forecast the sales revenue. You predict whether you are going to make such sales, how much are the sales in the future. Balance sheet items such as the inventory, accounts receivable, and accounts payable exhibit relatively constant relationship to sales. If the sales goes up, this item will also goes up. And projections on those items can be made based on projected sales. Other balance sheet items, particularly fixed assets, the debt, and equity, change only in accordance with the organization's policies and management decisions, and are therefore, it is independent of future sales. The second item is the project asset items. Common asset items that are most relevant in a projected balance sheet include cash, account receivable, inventory, and fixed assets. While the amount of cash expected to be generated from the forecast sale increase may accumulate at a comparable rate, the cash balance shown on the balance sheet is not necessarily in proportion to the sales increase. The organization may decide to reinvest part of the cash received, allowing cash holdings to grow at a lower projected rate. So you may decide whether you want to put certain amount of cash into a fixed deposit somewhere else. Both accounts receivable and inventory generally change in proportion to sales increase because more sales can leave more customers on account and require more inventory in stocks. Future changes in fixed assets are not likely to be in proportion to sales and often depend on the organization's decision about future capital investments. The third item, which is the project liability items, will be discussed in the next video. If you have any questions related to the projected balance sheet, you may leave comments and I will entertain them. Thank you very much. Bye-bye.